Hey everyone, my name is Anthony Massaro. I'm a certified financial planner here with Financial Planning Services over in Marlton, New Jersey. I get often asked by my clients, how to invest successfully. And while there's no proven bullet to the method, I wanted to go through some strategies that we always bring up to clients, and with every investment plan we develop, how we go about that process. First and foremost starts with your time horizon, right? So understanding what you're investing for. Is it a short-term goal within the next 1 to 3 years? Want to buy maybe your first home? Is it a more longer-term, intermediate-term goal where you're saving for a child's college purposes, next 5 to 10 years? Or is it something like retirement, which is 20 plus years away? Understanding that time horizon is extremely important. Once you get there, you then want to look at what your asset allocation will be. It all comes back to that time horizon, right? If you're looking at a 1 to 3 year time frame, probably shouldn't be investing that money in anything too aggressive or too risky due to that short-term volatility you could experience. So cash reserves, shorter conservative investments seem like the right choice in that respect. When you go to 5 to 10 years, maybe saving for college purposes, might want to commingle some aggressive investments with some conservative investments. And then when you're going out 20 plus years for retirement, ideally typically want to be a little bit more aggressive in looking at a more aggressive stock portfolio, typically to start there. After you understand your time horizon, you've developed your asset allocation, you want to understand, of course, what we call short-term volatility. A perfect example is 2020, where we saw the stock market drop about 25% in less than 3 months, but then end the year positive by the end of 2020. That's just a perfect example of the type of short-term volatility that can occur in the stock market. Way, though, to help mitigate your short-term volatility is through a strategy we call dollar cost averaging. Dollar cost averaging is simply when you're adding a fixed dollar amount to your investment portfolio at a specified date. That could be every month, it could be every 2 weeks. A lot of times this is already occurring in your 401k when you're making your contributions via your paycheck. What's happening there very simply is 1 month you may buy a stock, and let's use Apple. You buy Apple stock at $100 a share. The next month, Apple's stock is trading at $90 a share. Well, now, by buying $1,000 worth of Apple stock at $100 and $1,000 worth of Apple stock at $90 a share, you've averaged out to a cost basis of $95 a share, helping to mitigate that short-term volatility that is pretty much inevitable with the stock market over time. Albert Einstein once said that long-term compounding interest is the eighth wonder of the world, and I have to agree with him. The returns you can see over time compared to year by year can be drastically different, and this all goes back to staying invested in the market. 8% on 8% on 8% compounding over time is a lot different than a singular compounding moment you get in 1 year the next. And lastly, arguably one of the most important things in any investment plan is to continue to monitor your investments and obviously to consider rebalancing your portfolio. What I mean by this simply is if the stock market, for example, were to do very well over the next 3 years and your portfolio is 80% stock and 20% bond, that 80% figure might become 85%. But you still want to be at an 80-20 portfolio. You want to make sure to rebalance your portfolio to get you back to that 80-20 target. So continuing to monitor, continuing to make sure also to the investment objective you set forth and the time horizon still meets your needs is also crucial. I'm Anthony Massaro with Financial. Thank you so much.